Please welcome to the stage, Jason Schenker.
Thank you very much. It's a pleasure to be here today. I know you have a lot of questions about what's going on with the economy, financial markets, material handling industry, and more, and we're going to get to all of that. That's why today's topic is called The Storm Before the Calm. I know many of you are wondering, when are things going to get normal again? When do we return to normalcy? 2024 beyond? Is it around the corner? Well, let's start with the upside and downsides. You know, I like to always kind of cover what the big issues are, and I'm not going to bury the lead here. The upsides are good. The labor market's strong. Fed policy rates are near the peak. Total CPI has fallen significantly. Scavenger hunt economics that many of you have dealt with in the last couple of years, that's eased up. Consumer debt delinquencies are low, and the GDP outlook for now is positive. On the downside, though, there are more significant risks, especially internationally. Global growth is slowing. There's also still likely some monetary policy tightening ahead. Core CPI remains high, and with oil prices up, total CPI has started to tick back up again. Cold War II is ongoing, and it doesn't look like there's an end in sight. Meanwhile, corporate profits are under pressure, and commercial real estate's at risk. So there are significant downsides, but there's a lot of upside risk. And as I think about the expectations for the year ahead, I want to share three key things that I'm expecting. And that is a slower pace of U.S. job gains, slower U.S. growth, and slowly easing inflation. None of that necessarily means a recession. There's the hope, a great hope that we end up with a soft landing. But some of these things, these seem very, very likely to happen. Right? The interest rates are up. The cost of capital is high. Those things are going to add pressure. And I'll talk about that throughout my talk. And of course, there's maybe like a fourth expectation, right? Because there's also politics. A recent survey from Pew Research out just in the last few days showed 65% of Americans always or often feel exhausted when thinking about politics. Well, 2024 is definitely going to be an exhausting year for that. As I think about the industry impacts and the outlooks, let's talk about 2023 for a second. When we went into 2023, this is what we said. We were looking across industries. Where were there expansions? Where were there recessions? We were more optimistic about e-commerce, non-durable goods, and the consumer, as well as leisure and travel, industrial tech and consulting. But we were worried about construction, about housing, about autos, about industrial goods. As we look now to 2024, you can see quite a few things. Just to do the shift again, I want to go back. There we go. If we look here, that's 2023. And then as we go forward to 2024, you can see more things shifting into a tighter area. Autos, RVs, construction, still housing, metals and mining could have a really tough first half of the year. Even leisure and travel may ease off as we see interest rates beginning to weigh on the economy and some slower job gains going forward. But industrial technology is likely to be really important, and we still think e-commerce and non-durable goods are probably going to bear out pretty well in the year ahead. Now, as we think about all the drivers, what's going on right now, what's going on next year, the first thing I talked about, the biggest good news, are solid jobs. The unemployment rate is very low. It's 3.8%. You can see two graphs up here. The graph on the left is the unemployment rate. 2 years ago, it was between 5 and 5.5. Now it's 3.8. Now it's come up a little bit in recent months, but it really can't fall that much lower, truth be told. And if we look at payrolls, which is the graph on the right, the number of new non-farm payrolls every month, we see that was a lot higher 2 years ago, right? Between 600,000 and 700,000 jobs. Most recent month was 187. That's a lot lower, but with the unemployment rate not between 5 and 5.5 and only between 3.5 and 4, it's difficult to add lots and lots of jobs. And I'll talk about why in a second. The biggest piece of good news, though, about jobs, and this is the entire economy, 70% of the US economy is people buying stuff. And payrolls right now are at a record level. They have never been this high. There's over 156.4 million people on payrolls in August. All-time record. By the way, as you're looking at these graphs, a couple things. One, you're going to get a copy of the deck, so you don't have to worry about being a paparazzi in this section to try to take pictures of everything. The second thing is, these graphs come from the, I guess, somewhat cutely named Federal Reserve Economic Database, or FRED, and what you see here is there are shaded bars. The shaded bars represent time periods of recession. Right on the left, you see the '01 recession. In the middle, you see the Great Recession and the global financial crisis. On the right, you see the COVID recession. So you see payrolls going down during those bad times, and you see where we are right now at a record all-time high. And you might say, what about the labor force? I hear a lot of stuff about the labor force. Let's talk about that. Right now, the labor force is also at an all-time high. There's never been this many people working on payrolls, and there's never been as big a labor force as we have right this second. Over 167.8 million people in the labor force in August, and you can see that record in this graph. What about the unemployment rate? Well, the 3.8% is a survey where you're calling people and you're asking them, do you have a job? No. Are you looking for one? Yes. We count you as unemployed. That's the 3.8. But there's another way to calculate unemployment. And that's if we look at who's collecting unemployment benefits. And that's less than 1.7 million people right now. And payrolls, again, the labor force is over 167.8 million. And out of that, almost 168 million, there's 1.66 million, less than 1%, collecting unemployment rate right now, or collecting unemployment benefits right now. As for people losing jobs, super low numbers. The initial jobless claims most recent report around 200,000. Very few people are losing their jobs. And the labor force participation rate, it's true, it hasn't recovered to pre-COVID levels yet. You can see that on the right. It was higher before COVID than it is now, but it's been moving up. The good news is younger workers returned after COVID. This is labor force participation rate for ages 16 to 19. This has been trending higher since the end of the Great Recession. But some folks left the labor force never to return. They're workers over 55. You can see their labor force participation rate. It's nowhere near what it was before COVID. And if we want a more pronounced example, let's look at workers over 65. Now, these folks didn't leave to get TikTok famous. They've retired. That means they're also not coming back. The trick about labor force participation rates is, especially when we're talking about 65 and up, 55 and up, the calculation of participation doesn't have an upper age limit. So as the population gets older and we see the baby boomer generation shift fully into the above 65 and up crowd and beyond, right? We're going to have baby boomers here start turning 80 in 2026. It's right around the corner. This labor force participation rate number will probably go lower going forward because of that generational churn. It's not that people are lazy or young people are not wanting to work. That's not it. You saw the 16 to 19. That's been going up for 15 years. What it is some folks are retiring. It's just a generational churn. But the lack of people is a serious problem because right now there's over 8.8 million open jobs. Again, the number of people collecting unemployment is 1.66 million. There's 8.8 million open jobs. That's a more, right? You're talking almost 7.2 million more open jobs than people collecting unemployment right now. The good news is that even though the labor gains are likely to slow going forward, we have essentially a big backlog of open jobs. Look back historically at this graph. You see those recessions. You see the '01 recession when it was around 5 million open jobs that needed workers, or the Great Recession when it was around 4.5. Well, today it's 8.8. Even before COVID, it was 1.8 million fewer than we have in open jobs now. There were only 7 million, right? That was a record at that time, or near record. 7 million open jobs. So there's a lot of open jobs. It's really good for the economy. Again, people with jobs buying stuff is 70% of GDP. I would expect this number to keep falling, but there's a long way it can go down. By the way, during the Great Recession, it went from around 4.5 million to fall down towards 2 million open jobs. That was the bottom. Again, right now, we're at 8.8, right? More than 4 times that. So there's a lot of room for that backlog of open jobs to peel off before we be in a real crisis situation with the job market. But job gains are likely to slow. Manufacturing job openings are also running pretty hot right now. There's 550,000 open manufacturing jobs. That is fantastic. Now, it's lower than it was 18 months ago when it was over 1 million. But look back historically, before the big recession in the middle here, the Great Recession, there were only about 300,000 open manufacturing jobs before it. And by the end of the recession, there were only 100,000 open manufacturing jobs. Right now, we got 550,000. That's a lot of open manufacturing jobs. And it's also about 150,000 more open manufacturing jobs than before COVID, when manufacturing was also really strong. So yes, the backlog is going to be reduced going forward. And yes, we are likely to see job gains slow, but the jobs are there. And it's not just in 1 or 2 categories. Those of you who are on my regular monthly calls, I often show this chart, and I know the numbers are small in the back, but let me just tell you, if you look at construction, a year ago there were 353,000 open construction jobs. This year there are 363,000 construction jobs that are open. In other words, even though mortgage rates are at 7.31%, there are 10,000 more construction jobs open this year than there were last year. By the way, that's a big number of open construction jobs. And there's jobs open really just across categories. Even if you look at information technologies, there's around 250,000 open jobs in the IT space. There's a lot of jobs everywhere. And of course, I know tech layoffs, they got a huge, big push early in the year, lots of media attention around it. And it's true, Q1 was the peak. This graph shows the number of employees who were laid off in tech, the red bar on the left axis, and the number of companies announcing those layoffs is blue on the right axis. And you can see Q1 is the peak. Q4 was really the second worst quarter, but Q2 and Q3 have been much more modest. So the layoffs have really, really died down for the most part. And of course, wages are up a lot. $5.25 an hour since February 2020. I like to think I'm a young guy. I'm young-ish, 46. I remember working for $4.25 an hour. So it boggles my mind that $5.27 is what this has gone up in just a few years. And the wage increase piece puts pressure on OpEx. The other challenge, of course, is the higher wage piece is tied to the high inflation piece. And because you have such a tight labor market and so many open jobs, That's how you end up with the UPS negotiations, or the UAW strike, or Kaiser Permanente about to have a strike. Because you've got a situation where if you are labor, it's a seller's market. There's a lot of negotiation leverage there. And that's probably going to persist, although it may ease next year as job gains slow. So let's talk about the inflation piece for just a second, because this is the other big piece of the equation. If you want to play central banker for a minute and imagine what your job is, and I'm sure you might think it's quite exotic to go to all these different Fed events and give talks and things about the economy, but really your job is to sit there and weigh with a set of scales two things. One is full employment. The other is low, stable prices. Do we have full employment? You've just seen the data. You know we do. Do we have low, stable prices? Fed's definition is long-term inflation target at 2%. We're not there. That's where the Fed's focus is. This is the CPI chart. The blue is the headline inflation. That includes everything you buy, food, energy, and everything else. Red is the core. It's what the Fed watches that excludes food and energy. As you can see, the Fed's 2% target's on the bottom axis of the graph right now, so we're not there. The blue line fell significantly from June of 2022, when it was 9.1%, down to just 3% this June. But then it ticked up a little in July and in August, and in the September numbers that we're going to get this month, we think that both core and headline CPI are likely to be at or above 4%. Here's the secret: 4% isn't 2. 2 is the target. So this is why the Fed could be under pressure to raise interest rates a little bit further. So why did the CPI fall so quickly, right? This is a pretty precipitous drop. And if you look in February, the blue dot was at 6, and by June it's at 3. Wow, that's tremendous to get inflation to go from 6% to 3%. How could we do that again? Well, here's the trick. As we look, this is the first half of last year, and this is the first half of this year. What you'll notice is, even though the inflation rate went from 6 to 3% this year, again, this year is on the right, none of those months were negative. So it's not that prices went down, because there have been exactly 0 months up here where prices went down. What happened is prices went up less this year. So compared to last year, looks pretty good. And that's how it goes from 6 to 3, because last year was so horrendous. But this doesn't send prices lower. And what it is the prices are still going up. And then we add to that mix the fact that oil prices have gone up significantly on Russian and Saudi oil production cuts. Oil prices at the middle end of June were in the mid-upper 60s per barrel, and now they're in the 90s. People talking about $100 oil, people talking about $150 oil. So that's not very helpful when you're trying to get inflation under control, to have more, inflation. This is the problem. And the Fed's upper bound is currently at 5.5%. It's the current upper bound for the federal funds rate. And fortunately, the Fed tells you what they think they're going to do. And I know this is really small, so let me just blow it up. They're expecting that by the end of 2023, the federal funds rate will be 5.6. Again, right now, the upper limit's 5.5, and the members on the Fed themselves expect that by the end of this year, it will be 5.6. This isn't like old data. This is from September 20th. That means they're expecting to raise rates one more time this year. They're also expecting to keep interest rates higher for longer. For the end of next year, they expect interest rates, the average, the median range will be 5.1. at the end of next year. So that means we're going to get one more rate hike here and then a couple of rate cuts probably next year based on their forecast. And then it might be as low as 3.9, which is great, by the end of 2025. So it's going to be a minute. And that's because the inflation piece is so persistent. Part of the reason it's so persistent is growth has been really good and there's lots of jobs. And why has growth been good? It's because there's so many jobs. Everybody's making lots of money. Everybody has a job. Payrolls are at record sizes. This is what's going on. And in Q2, GDP was 2.1. What about Q3? What's the expectation? Well, the Atlanta Fed has an iterative model that shows, based on currently available data, this is the September 29th iteration, GDP for Q3 could be 4.9%. Good news, that is not a recession. Bad news, that's like a lot of growth. And that's going to give the Fed license to raise rates. This is also something that is sending up the dollar. The greenback has strengthened significantly after inflation turned around, right? It looked like, you know, you're going from 6 to 3. All right, here we go. We're like coming into 2. Nope. Turning around. Going for another approach. So that sent up the greenback. For those of you who are in exports, we see it in the monthly MHI BAI index. Exports took a really big hit in the most recent month. The dollar is really strong. And of course, some slower global growth dynamics also are likely to be dollar supportive. For example, you may have seen the note I sent out about an hour ago on the PMIs, the Manufacturing Purchasing Manager Indices. This went out just this morning. The Chinese Caixin was positive but slowed, and it's just barely positive. 3 lines are up on this graph: red, green, blue. The red line right close to the axis on the right, that's the Chinese Caixin Manufacturing PMI. The blue line and the green line, you see them kind of spiking up to the right and then falling down. The green line kind of way down low, that's the Eurozone Manufacturing PMI. And between the Chinese line near 50 and the green line way below, that blue line, that's the US ISM. These are surveys of purchasing managers who work in manufacturing, and it's a leading indicator because when do you purchase stuff? Well, you purchase stuff when you have orders to fill. And when the orders get filled, they get sent out the door and get counted as GDP. Plus, manufacturing is a capital-intense industry, so this tends to lead economic growth. China's had a tough go. They've only shown modest expansions in 5 of the past 14 months. The Eurozone has been contracting for well over a year now, month after month after month after month. That means the orders fall. Are they going to be lower next month? Yep, they're lower than the previous month, and lower than the previous month, and lower than, right? For like 15 months, I think, is what we're at now. The US ISM has also been below 50 for a little while, but it ticked back up. It's still below 50, but it was at 49 for the month of September, so we're almost back to break even. For the Eurozone and the US, the saving grace is that giant mountain on the right. Record levels for the US ISM and the Eurozone Manufacturing PMI. Those came in the wake of COVID, and they resulted in a backlog that many of you have managed in your own businesses, playing scavenger hunt economics, trying to get the people you need despite a really tight labor market, trying to get the components despite trade issues and port blockages and all kinds of problems. Well, even though it's contracting now, that backlog is still there, keeping many businesses in this industry carried forward. China, though, is having a tough go. They didn't have a big bump the way the US and the Eurozone did. And they're struggling now with other economic problems. So each of these has a break-even of 50. When it's above 50, that means it went up in a given month. If it's below 50, it means it contracted. There's 3 series, 50 break-even. We aggregate them, break-even of 150, and you can see what it looks like here. This is the sum of the 3 series. You see the record all-time high on the right, driven by Eurozone and US strength. You can see the Great Recession far on the left, the COVID recession on the right, and where we are right now, below 150, not in a catastrophic way, but it's weak, it's contracted. Global growth is soft. This is why we've seen this show up in a number of different markets. We could put up almost any industrial metal, but let's take copper. This is copper prices on a weekly basis. You can see how they've been falling this year on trend and how much lower that is than it was a year and a half, 2 years ago. And of course, steel prices are an entirely different story. Those have been falling as well, although they've taken a particularly hard hit in the last few weeks on the UAW auto strike. And the reason that price has taken a hit is this is the Midwest delivered hot-rolled coil. So the Midwest pricing taking a particular hit for steel. Iron ore prices, though, are actually up, global iron ore. So there are a number of different things going on in the global economy and domestically that are impacting these markets. And as you think about what's going on in the rest of the world, I would offer a sanguine perspective on global supply chain. This is the New York Fed's monthly global supply chain pressure index. You can see the crazy COVID times on the right-hand side of this graph, that mountain of stress in the global supply chain. It's eased up. Look at where we are now compared to that. These are easy times compared to during COVID, but the tightness is picking back up a little bit. Something to keep an eye on. Along those lines are the risks associated with Cold War II, which doesn't show any sign of ending soon. Many of you know that for the last year and a half, I've been expecting something that looks like Koreanification, where we end up at some point with some kind of a stalemate, something that looks like an unpleasant, begrudged, not discussed sort of armistice thing, where you end up with demilitarized zones and weapons pointed at each other for decades. That still seems to be the most likely scenario, despite some recent gains made by Ukrainian forces to breach through Russian lines. One of the biggest impacts of this has been high inflation in Europe. If you think we have problems, Europe's in a bigger pickle, and that's because of their proximity to the energy, which had been so cheap for so long from Russia, and also because Europeans have a lot more defined benefits pensions and not defined contributions. Means they have more fixed income, they have more bonds, they have more debt. High inflation is deadly to pensioners in that situation. Europe's in a really tough spot. Their inflation right now at 4.3%, core at 4.5%. Both of those are currently higher than ours. The other thing I'd point out is if you look back at time, you'll notice this chart even goes negative because sometimes the ECB has fought to keep inflation positive, which almost no inflation is not a horrible thing for an economy that has a lot of defined benefits pensioners with a population that's about on average 10 years older than the US. But with high inflation rates, it's a really big risk. The other fallout from this is what's going on, of course, in China. And you may wonder, is it a good place for US entities to invest? I would share a recent quote, which is uninvestable. So said the US Commerce Secretary in August. I would add to that the State Department's view on China, that right now mainland China is considered a level 3 travel restriction. That means you should reconsider travel. There's only 4 levels. 4 is do not go. Level 4 includes Afghanistan right now and Iran, North Korea. Like, it's a small cadre of countries. But China became level 3 because of the arbitrary enforcement of local laws, including in relation to exit bans and the risk of wrongful detentions. This actually happened to an employee of a US company just this week, where, by the way, you don't find out U.S. citizens and U.S. employees of U.S. companies might only become aware of an exit ban when they attempt to depart the country. Y'all remember when oil prices came crashing down in the last cycle and folks were talking, what are we going to do with shale? I remember sitting down with some oil and gas companies, and there was a big question about what would we do with all of our shale rigs? I had this one conversation, large public company, and they said, well, maybe we should send, we know there's a lot of shale in Argentina, maybe we should send our rigs there. And I said, Argentina's a great place to send your money if you never want to see it again. Well, now, maybe you have some colleagues you don't really like, and I'm not saying, but like if you never wanted to see them again, you have options. But economically, the impact of this has actually been quite positive for the USMCA and NAFTA region. Mexico is now officially the biggest US trading partner. It eclipsed China in the most recent trade data. This is a big deal. You're seeing the NAFTA region become more economically integrated. By the way, those 550,000 open manufacturing jobs, yeah, we could see manufacturing jobs both in the US and in Mexico remain really strong as we see companies try to disentangle the supply chains and pull more, especially dual-use technologies, out of China. Now, I want to talk for a minute as we think about what our other risks are, but also some points of leverage around debt, credit, and housing. And I know we just avoided, almost at the last minute on Saturday night, a government shutdown, much to the surprise of, I think, everyone on Capitol Hill as well. But we got there, which is great. It's a huge problem because if we'd had a shutdown, shutdowns are actually more expensive than if you don't have a shutdown, right? You end up spending more money in furloughing people, and then work doesn't happen, but then you back pay for work that doesn't happen, all kinds of crazy, right? But we have a lot of government debt. It's currently over $33 trillion. And our debt service has been around $1 trillion a year, but with these higher interest rates, it could become $2 trillion. And if we don't kill inflation, debt service in this country could end up above $2 trillion a year. Could be 3, 4. That's why the Fed really wants to kill inflation. That's why killing inflation is a bipartisan or a nonpartisan issue. Because we all owe money, not just the government, but also consumers. There's a record level of debt, over $17 trillion in debt. You don't want to refi that at super high interest rates. Fortunately, 70% of the debt held in the United States is in mortgages right now. And very fortunately, we have some of the lowest delinquencies on debt on record in the United States. The record low was 2.5% of all the debt, that entire $17.2 trillion or $06 trillion, right? Out of that, only 2.6% is currently delinquent. The record low was 2.5%, set back in just 2 quarters before this data in Q4 of last year. So Q4 last year is the record low, and Q1 of this year and Q2 of this year were 2.6%. That's really good, because as you look, there's numbers up on that chart that are a lot bigger from the last cycle. You look back at 2009, 2010, it was knocking on 12% of all debt that was delinquent. We're at 2.6%. And all those mortgages, since Q1 of 2020, 2/3 of them have been issued, the dollar values, 2/3 of all that mortgage debt has been issued to people with 760 plus FICO scores. Those do not fall out of the sky. And the interesting impact, you wonder, why does it seem like everybody has money? Why is everybody traveling? Why is everybody spending? When people were able to refinance or get mortgages at this low an interest rate, that didn't free up their cash flow for 1 year. It frees up their cash flow for 30 years. So people with super great credit were able to lock in debt at the lowest rates in history, and that frees up decades of cash flow. It's really good if your economy is consumer-driven, which ours is. Again, about 70% of GDP comes from consumers who owe almost nothing delinquently, and we have really rad mortgage credit. And if you're wondering, though, how is it, though, that home prices now they're going back up? Like, what's going on? Part of it is there's not much to rent, other than in the last couple of years. You'd have to go back to 1985 to find rental vacancies as low as they are now, 6.3%. So there's almost nothing to rent, and that's the big secret, right? Everybody's got a job, more payrolls in history, and people making more money than they've ever made, with more people with jobs than we've ever had, want to live somewhere, and there's almost nothing to rent. We'll add to that the risk that multifamily starts, 5 units or more, has recently fallen. We're not building enough multifamily. Single-family homes, those are pretty weak too. This sounds like a supply and demand situation, right? And I know many of you, like me, remember the housing crisis and wonder, oh my God, like what's going to happen to housing? The mortgage rates keep going up. New York Fed shows that in July, home prices nationally were up 2.5%. It's not the same everywhere. Travis County, where I live, in Austin, Texas, is down 12% year on year, but our home prices are up a lot from a few years ago. Miami-Dade County, which begins just about a mile and a half down the road, they're up 9% year on year. Some of that's money coming in from Latin America. There's some political instabilities in Argentina, Venezuela, Brazil, even Chile. So you've got folks coming in, and that's driving up demand too. So there's not much supply, lots of demand, prices are high, and that's with mortgage rates at 7.31. So I'd like to offer a consideration of what will housing prices then do. Let's say 2 years from now, Fed funds rates back to 3.9, like the Fed says it will be. In about 2 years and 4 months, they're saying we're going to be at 3.9 for a Fed funds rate. What happens if mortgages at that point are at 4.5, 4.75? What will home prices be like then if we're not building anything and we still have pretty good jobs and then mortgage rates go lower? It's not supply. Prices probably go up. They could go up a lot. So there are areas of opportunity looking forward, and some that are persistent, like e-commerce. Most recent data shows we're at a record right now, almost $278 billion in Q2, new record. As a percent of all retail, it's strong, over 15.4%. It actually accelerated in Q2 from Q1. Which leads me to the material handling outlook, which is good. I know there's going to be some smaller charts. I'm going to put up a bigger chart in a second. And again, you're going to get all these charts after the talk. Forecasts up here from August and October. Our new orders forecasts haven't changed. Last year was a record year. According to the government data, almost $46 billion in new orders. This year, $45.8 billion last year. This year we expect it's going to be 45.6. Second best year ever, almost as good as last year. Shipments last year, 43.6 billion. We revised the forecast for 2023 a little lower to 46.2. Keep in mind, 43.6 was a record last year. 46.2 will be a record this year. Record year for shipments. And of course, the difference is what happened last year. Shipments were weighed down by the backlog. We've seen that over the last year and a half, 2 years. But now we see shipments are coming back a little harder. Unfilled orders continuing to trend higher, inventories as well. Now, these are in dollar values. So the fact that prices are going up is also supportive of why these dollar values go up. In percentages, the thing I really want to highlight, and maybe we'll do it this way instead, the gray bars are 2020, 2021, 2022. Looking 23, 24, 25, there's only one red number up there this year. New orders down 0.5%. The very slight difference I mentioned earlier. We otherwise think they're going to pick up in the next 2 years. Shipments this year are likely to be up 5.9%. It's a good number after being up last year 23.5 and the year before 15.5. Slowing down a little in 2024, picking up again in 2025. There are some downside risks to slowing activity in the first half of next year, but we believe total CPI is likely to be at or below 2% in Q3 of 2024. That means if the Fed wants to think about cutting rates, it's probably going to be in the back half of the year. But things could slow down a little in the front half. Let me show you what some of these graphs look like as we think about the new orders and the record levels and the surges since COVID. That's new orders. Year to date, up 6.6%. If we look at the MHI BAI, for those of you who aren't receiving this, please let me or one of your MHI colleagues know. It's been a choppy year. These surveys show a break-even of 50 if it's above 50. That means it's an expanding month. If it's below 50, that means it's contracting. And you can see the last year and a half has been kind of choppy. The red boxes are the 3-month averages. It has improved in the last 4 months. Shipments rising up. Big strength in the wake of COVID, still strong now. Year to date, up 10.7% through July. Wow. And shipments look even better in the MHI BAI. You can see here that most of the months have been above 50, the blue dots, and the red boxes in the last 2-3 years, there's only been a handful of times when the red boxes, the 3-month averages, have been below 50. Shipments have been good, even though new orders have been choppy. What's going on? Well, this has a lot to do with unfilled orders, right, which have also recently risen to record highs. You can see that unfilled orders built up significantly in 2020, 2021, and parts of 2022, but they've been falling recently. And inventories, which the dollar values hit recent record highs. Those also, according to the MHI BAI, had been building up in 2020, 2021, parts of 2022. Just like with the unfilled orders, this was whip. This was stuck. This was stuff that got stuck, and you couldn't get it out the door. So new orders have been choppy. Shipments are strong, but unfilled orders have been falling, and inventories have been falling. What is going on? Whip is going out the door. The scavenger hunt economy frees up a little, and more of material handling can be monetized. Looking forward to future new orders, this is probably what I'm most optimistic about. Blue dots represent individual months. Green boxes are 6-month moving averages. And you can see in the last 9-12 months or so, it's really been picking up. That bodes well for the second half of next year. I feel quite strongly about the outlook that by the end of next year, based on this data, based on the Fed's imminent end of rate hikes, there's likely to be some upside in the end of 24 and into 2025. Now, there are a few other pieces that we should probably address that will be important for how your businesses are run. First is climate change and emissions reporting. Because ready or not, sustainability reporting is coming. This is the SEC rule proposed in early parts of last year. It hasn't yet been ruled on by the SEC. There is no timeline for it being ruled on. But the proposed rule would require large accelerated filers for fiscal year 2023 to report their Scope 1 and Scope 2 emissions, but not Scope 3. They would require, though, large accelerated filers to report their Scope 3 emissions for the fiscal year 2024. So this is just around the corner, and it hasn't yet been ruled on. This also matches in with what's going on in California. Many of you may know that an emissions reporting bill that would affect companies that operate in California has been passed by the California legislature and is sitting on Governor Newsom's desk. I think he has until October 14th to sign it into law, and it seems like he will. If that happens, and you have operating facilities in California, you may very well be required not just to report your Scope 1 and Scope 2, but also your Scope 3 emissions. If you want to know more about what these terms mean in sustainability, there are a series of training videos that MHI has online, some of which I've recorded, and some other materials I've prepared, and articles on this topic as well that can help you to be informed as this evolves. You might be wondering, is this purely political posturing? Is it just a partisan sort of thing? Interestingly enough, Pew Research conducted surveys. Again, they're a nonpartisan think tank. They do research on what Americans think about stuff, and 74% of Americans support the U.S. global role on climate change, including the fact that 2/3 of Americans prioritize developing alternative energy sources like wind and solar, and 69% favor the U.S. taking steps to become carbon neutral by 2050. So that's a big swath of the population. It's not as many Americans who are very concerned about the situation with China, which exceeds 80%, but 74 and 67 is still the vast majority of the country. Now, there are some limitations on net zero plans. Last year, there was an article published by Bloomberg, including data from the New Climate Institute and Carbon Market Watch, about what big companies were doing to plan for offsets to achieve net zero emission targets. And of the 25 biggest companies in the world, 13 had offsets with insufficient permanence, nature-based solutions. What does that mean? That means planting trees. That's what 13 of the 25 biggest companies were saying. The other 12 were a mix of no published details, uncertain, and claims without a neutralization claim, right? In other words, 13 are planning to plant trees, and 12 are a mix of no idea, no comment. I don't know what that means for the rest of us, but that means it's difficult. What's also difficult is that there's going to be a lot more people on planet Earth in the future. Now, I don't have kids, but I hear that they don't show up in the delivery room with all the hydrocarbons they're going to need for their lives. And the population of planet Earth in 2020 was around 7.8 billion, and in 2050 it's going to be around 9.7 billion. It's a lot more people. And by the way, there's already 750 million people living in energy poverty, and another 750 million or so that don't have clean cooking fuels. So you've got about 1.5 billion people without sufficient energy, and then we're going to add another 1.8 billion to that. So you're going to have, 3.3 billion more people who may wish to consume energy in the future. That's going to be challenging. What's also challenging is there's not enough metals to meet the net zero emission goals. This data from the IMF shows the supply-demand balance of different materials that go into the electric batteries that many think will just be the panacea. It solves everything. Let me explain what this shows. In the upper right, there's a blue dot next to the number 1. 1 means we're currently producing enough of that material we need to get to the net zero plans we have based on all the proposals out there. That 1 is lead. That's the only thing we're producing enough of right now on planet Earth to get us there. We're only producing 60% of the copper required, 35% of the nickel, or 20% of the cobalt we're going to need. That's a problem. What's also a problem is a bunch of this stuff comes from materials, and it comes from China and Russia. And you can see it here. This is a lot of the stuff we need for the clean energy and the clean tech and the battery revolution. It's very tough to get there if we end up in a full-blown Cold War II, and even commodities don't move across continents. So let's take it up a step. Let's talk about the key economic takeaways. I want you to walk away thinking about a few things. The first is that U.S. growth right now is solid. That's because jobs data are good. Jobs drive growth. CPI, consumer inflation rates, are elevated. They're nowhere near as high as they were, but they're not where the Fed needs them to be in order to crush inflation. And it's important to crush inflation because of all the debt we have. I don't know if you've seen it, but right now the 20-year Treasury is almost at 5%. That's not good. You want that down. The global economy, China, and the EU are slowing. Good news, the US right now is pretty much the only game in town. We keep raising rates and our GDP still looks great. Now, that's probably going to slow down in the year ahead, but we're still in a much better spot than the EU or China. And there are three economic expectations I mentioned at the beginning for the year ahead, and that is we do expect slower job gains, slower growth, and slowly easing inflation. We don't see a collapso situation, but we do see things slowing. And as business concerns, the implication of all that is to be aware that there's a risk of persistent inflation and high interest rates, that OPEX and CAPEX could pressure profit margins, that Cold War II will continue to incentivize further decoupling, tight labor markets support labor leverage right now. That's a challenge. And risks of a global credit crunch lie ahead. And of course, 2024 will bring plenty of political hijinks. And with that, disclaimer, I know you've all read it, everything can be wrong, and me. And I thank you very much. It's a pleasure to be here. Thank you. I don't think we have any time for questions, but I know we do have a survey question, so if you wouldn't mind answering it, I greatly appreciate it. And I will be here until Wednesday. So if you see me around, you have a question, you want to talk to me, come and find me, but I know it's lunchtime. I won't hold you from the food. I'll see you soon. Thank you.
Ladies and gentlemen, lunch is now served in the Great Hall foyer.